So Gap Inc., which also owns Old Navy and Banana Republic, is one of the latest among many retailers to announce that they've stopped paying rent payments at their 2,785 North American locations to preserve cash during the shutdowns. Other restaurants and retailers like the Cheesecake Factory, H&M, Subway, and Mattress Firm all preemptively requested some sort of rent relief for April, and several alerted their landlords in March that they wouldn't be paying rent in April at all. So with a retail landscape that was already struggling before all of these shutdowns and closures, what are the implications of everything that's going on right now, and how is this going to affect the retail landscape going forward? That's what we'll cover in this video. Hey guys, this is Justin for breakintocre.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the commercial real estate industry or do your first deal, make sure to subscribe and hit the notification bell. So in a recent report by Daytex Property Solutions, which is a real estate portfolio management and reporting software company, the company used real-time data from its users to track 118 retail and restaurant chains across the US in order to find out who paid rent and who paid expense reimbursements for the month of April. And the results of the report, which were reported by The Real Deal, were not great. So according to this report, which includes data up to April 17th, national tenants paid only 53% of their build costs in April, down from 87% paid by the same day in March. And for tenants without a national presence, this number dropped to below 50% at 47% of rent collected for non-national tenants through April 17th, down from 81% at the same time 1 month prior. And out of those 118 retailers, 19 of those retailers hadn't paid any base rent or expense reimbursements at all during the month of April. Some of these tenants included Foot Locker, Old Navy, Nordstrom, AMC Theaters, Dave & Buster's, Barnes & Noble, and LA Fitness. Now for companies that were paying rent payments, not all of these companies were paying full rental payments or full expense reimbursement payments. Several companies were just paying partial payments, including Dick's Sporting Goods, 24 Hour Fitness, Panera Bread, and Supercuts. Now, not all of these companies were skipping rent payments partially or in full, and many of these retailers did pay rent in full in the month of April. And to no surprise, many banks, grocery stores, and pharmacies topped the list of tenants paying full rent, with retailers like Wells Fargo, Chase Bank, Trader Joe's, Whole Foods, and Target all making the list of tenants that paid full rent in April. Fast food restaurants like Chipotle, Chick-fil-A, McDonald's, and Domino's Pizza all paid full rent in April as well, as quick takeout ordering and contactless delivery has been one of the only options for people who don't want to cook at home during all of these stay-at-home orders across the country. So obviously there are many retailers out there that are struggling right now. So what kind of implications does this have for the retail real estate landscape, and how does this affect real estate investors going forward? Well, number one is that this is likely just accelerating everything that was happening in the retail sector before all of these shutdowns and closures started to occur. Many retailers that were in a bad financial position before all of this happened are being exposed much more quickly, which is just accelerating the demise of retailers which have seen dwindling demand at their physical locations over the last several years. So as cash reserves dwindle for many of these companies, bankruptcies that we may have otherwise seen maybe 3 to 5 years down the road from now might happen in 2020 or 2021 for a lot of these firms that were already on a path to closures before any of the events occurred in 2020. Now on the other end of the spectrum, and also talking about acceleration, we're also seeing an accelerated push towards trends that we've already been seeing in the retail space. This includes the major shift towards e-commerce, mobile food delivery, and watching Netflix at home versus going to the movie theater. Necessity-based retail has also been a buzzword in the space over the last several years, with many retail investors flocking to necessity-based retail to find safety in a retail real estate investment. And those predictions of those companies' successes have definitely rang true throughout the last few months, with retailers like Target, Walmart, Trader Joe's, and Whole Foods all paying full rent for the month of April, which will likely continue going forward. So whether a company was going in a positive direction or a negative direction before all of this started, it looks like these shutdowns will effectively speed up time, with society adapting new trends now more quickly out of necessity. And if these people find that these trends are easier, quicker, more affordable, or more convenient, this will likely stick for years to come and create a new normal in the retail space bringing to the present day what may have occurred anyway over the next few years organically, even if no big crisis ever happened and things were just business as usual. And speaking of habits sticking, the second big implication of this is that if these habits become more permanent, retailers are going to need to continue to adapt to things like mobile order and delivery, but at a much quicker pace. Sales through apps like Uber Eats, Postmates, and DoorDash have all grown significantly over the past 2 years, with more and more people choosing food delivery and ordering directly from their phones. And according to the data analytics firm Second Measure, collective year-over-year growth for meal delivery services was 24% between March 2019 and March 2020. The firm also reported that in March of 2020, 28% of US consumers had purchased some sort of meal delivery online, which was up from 22% in March of 2019, and that number will likely continue to grow as people are staying home for longer and longer periods of time. Once this becomes more of a norm, it's going to be much harder to convince people to go out to a restaurant location, especially fast food restaurants, where the focus is on the food itself rather than the experience of getting people together and having a meal. And the restaurants that sign contracts and form partnership with these companies are going to be the winners going forward, and this is already occurring. In fact, 11% of March sales for Buffalo Wild Wings came directly from DoorDash orders, and 9% of Chipotle sales came directly from DoorDash orders as well. These restaurants also each both have their own easy to navigate app, making it really easy and simple for people to place a customized order and have that food at their doorstep in less than 30 minutes. And in food service, especially for quick service restaurants, speed and convenience is the name of the game, and the retailers that can adapt to this most quickly are going to be the winners now, but also after shutdowns are lifted. So with all of that said and the implications on retailers specifically, what does this mean for commercial real estate investors, and where is the opportunity from all of this going forward? Well, right now it's clear that many retailers are struggling, but necessity-based retail like grocery stores, drugstores, and many fast food options are still performing really well, even during this down part of the cycle, and could be one of the safest places for would-be retail investors to park their money today. But if you're not focused on safety and you're looking to take advantage of the shift that's happening in retail today, one of the biggest opportunities in retail right now might be repositioning dead retail space when inevitably many of these stores and restaurants don't end up opening up again. Many large regional malls, neighborhood shopping centers, or strip centers that are already seeing their tenant base dwindle due to changing consumer behavior are also generally very well located and proximate to things like major highways, schools, office space, and residential neighborhoods as well. This presents a huge opportunity for retail real estate investors to go in, buy a property at distressed pricing, and then repurpose that property to fit a need that's occurring in the market today. So for areas with housing shortages, like many of the areas in the US that have enacted rent control guidelines over the last few years, many of these retail properties could be demolished and repurposed into multifamily or single-family homes. And for areas that are great last-mile industrial locations, this could mean converting an existing strip center into an industrial warehouse in order to get products ordered online to customers more quickly. And for areas that are specifically business and technology hubs like many downtown areas, this could mean turning a dying shopping mall into an office campus with retail and other amenities that directly support that new use. In fact, this is already happening in many US markets. In San Diego, for example, Horton Plaza was a dying shopping mall in 2018 and was acquired by a developer in 2018 with the intent to repurpose the property. And with the project about to be underway, 700,000 square feet of office space and 300,000 square feet of retail space are planned for the new development in the heart of downtown San Diego, filling a direct need in the market just by repurposing existing space. Now, obviously, not every project is going to be of this magnitude, but these are the kind of opportunities that you might see in the next 1 to 2 years as many consumers adjust to the new normal, and many effects of these shutdowns and closures are more permanently etched into our society and the way that people interact with retail stores. So to answer the question directly, is retail dead? No, it's not, but it's changing at a faster pace than ever before, and at a faster pace than any of us would have expected going into 2020. But with change always comes opportunity, and the retailers and investors that get ahead of these new trends in consumer demand are going to be the winners coming out of this, as retail is going to look very different in 2025 than it does today in 2020. So I hope you found this helpful in navigating everything that's going on in the retail and commercial real estate landscape as a whole right now. If you like this video and want to see more content like this, let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.